Hello, everyone. Jeff Fratarcangeli here, Fratarcangeli Wealth Management, for another call to action. Many of you have followed us over the years, know that when things get a little, call them hairy or concerning, we come to you with some of our partners to talk about what are we doing, what's happening, what should we be considering, how do we calm the situation mentally, and make sure that we're looking at this from a clear lens and opportunistic lens. And, getting into why this is happening, I'll touch on. But before I do, those that are joining maybe for the first time, Fratarcangeli Wealth Management's been in practice for 30 years, 30 plus years now, as of December of, call it 2025, when I started as a rookie working in the World Trade Center, Tower 2, 73rd floor. Feels like yesterday. And here we are 30 years later, having experienced the explosion of the, call it first iteration of the tech, call it information age explosion, and the technological advancements that we endure and take for granted today, like this type of conversation. And throughout the periods that followed, whether it would be the bubble, call it tech bubble, the dot-com bubble. Then it was 9/11. We all forget so quickly 9/11 occurring, and of course our World Trade Center no longer being call it the skyline for New York to the level that it once was. And of course the lost decade, and then of course the financial collapse, the real estate bubble. All that came with the follow of the financial collapse, with the bailouts and the bank regulation and the over-regulation that we come to find out called mark-to-market. And then, of course, COVID. All of this going on in a matter of 30 years, what feels like a blink. And tomorrow will be the same, I assure you. And creating relationships. Fratarcangeli Wealth Management is comprised of not only my experience, but over 300 years of experience with over 30 professionals that are predominantly licensed, that have different roles to guide and counsel our client. Our role as advisors is to focus on everything involving your businesses, your family, your tax planning, your investment strategies, your cost of doing everything from insurance, property, casualty, healthcare, to mortgages, to both sides of the balance sheet, and essentially guiding and counseling how we should have been investing and what cadence is going to give us the best outcome. And I would say the theme is best in class, having the best in class in every category, creating a competitive environment when we look at solutions in each iteration of our financial picture, and leveraging our resources in an appropriate fashion of best in class is what we are here to do as a multifamily office, working with many of you, and leveraging our network and leveraging our folks that we're going to be introducing here in a moment. But here we are today. We've got this geopolitical tension with Iran and the U.S. and Israel, and everything that's coming with that, and the disruption that it's creating in oil prices. And how does that going to affect us as we look at the Fed? We've seen the Fed indicate that with the new Fed chair coming in May, that we soon don't hear about as much with all the other news, but we know that the Fed is expecting to lower interest rates at least twice this year. Now with some of the data and the economic numbers that we've seen, very strong productivity, very tame inflation, but yet the unemployment numbers that we saw recently could actually lend itself to a rate decline even sooner. We'll see what our guest gentleman will have to say about that. And then let's not forget earnings. We're here in the second chapter of this explosion of blockchain and AI and technology, and all the impacts it has from an ease and convenience of execution in all fronts, and the infrastructure necessary, and just the explosion of earnings. I can talk, which many of you have heard many times. We're not here to hear me today. We're here to hear my partner, Bernhard Koepp. And Bernhard, the reason I continually bring you back at integral times, whether it's post-election, pre-election events, and here we are with a call to action because of the amount of volatility, and I think concern that's not going away anytime soon, based on what I'm hearing on all tabloids and as well as news outlets. Bernhard, you have international exposure. You worked in London for Deutsche Bank. You've been considered one of the best asset managers in the field. You have been ranked as such in some of your strategies, like the Bulldog strategy, which we've been using for over a decade. You'll talk more about. You're in one of the longest standing research firms, CJ Lawrence, over 100 years. It's not by accident. You're the one I usually lean on when I'm most confused, if you will, as to what's happening and what could happen. And Bernhard, what is this oil gyration that's ranged from over $100 a barrel to back down to in the mid 70s, and now back up above 90? How much of an impact does that have on the projected numbers that we have seen so far, if you don't mind?
Yeah, no, look, Jeff, well, first of all, thanks for having me back. It's always, I love these conversations we have, and I think we always, try to end these conversations with, a call to action. Where do we invest? What do we do with our portfolios? And, Jeff, you and your team have been second to none in creating portfolios for your clients. So look, we're going through an oil shock. So, there's the math we can do on this, which is pretty simple, actually. So every $10 you put on the barrel takes about 0.2% off GDP. I mean, that used to be the rule of thumb. It's actually lower now because we are an exporter of oil. So it's probably, you could even say it's probably zero point 0.1 impact because there is a actually a business, a positive impact on our oil producers here that is also driving our economy. We're no longer just a consumption-led economy. We're also, an oil-led economy, and that's something we need to remember. So let's take the worst case scenario here. I mean, look, oil today hit almost $100, and for Brent, WTI is around 95. That's not sustainable. I mean, all the speculators went into actually this conflict, shorting oil because we've had a glut of oil in the world, and demand was actually falling. So you had a lot of short covering in these positioning, and it's really the question mark: how much is there disruption of the flow of oil through the Strait of Hormuz, which is something we haven't seen in this intensity, at least in our lifetimes. So there's a little bit of speculative kind of short covering here, which is driving the oil price really high. So we've had, policy actions coming in. We're releasing oil from the strategic reserve. That's happening in the US. That's happening in Europe also. Every major developed economy is releasing oil into the system. So, I would wager that a week from now, oil prices will be much lower. So let's take a base case for oil. Before the conflict, we were at around 65. Let's give a premium, a risk premium of $7 to $10 for the war. Okay, then we get to 75, or let's say 80. Okay, that takes 0.2, 0.3 off of GDP. Okay, so our base case for GDP going into the year was around 3%. So now we're down to 2.8. So, that's the oil impact. But again, I would wager that, with, the military, I mean, we've taken out all of the capabilities basically that Iran has to disrupt. There's still some mining, mining the Strait of Hormuz is a concern. Drones are a concern, but I would wager that a week or two from now, that may not be a problem anymore.
Interesting. Excellent. Well, you put it into a number, GDP, productivity. We saw the ISM numbers come through very strong, both on service and manufacturing. And then, of course, we saw the unemployment numbers come in. If you don't mind, talk about the Fed. We
Yeah.
soon forget that we have a new Fed chair coming in May. We know that the odds of a rate decline went to 50% in June. I know they speak next week, but it's out of a sort of how do they say, not really much emphasis because there's going to be a change. What do you think the Fed will do, one, or what they should do, and furthermore, how it affects all that we monitor on short term as well as the 10-year Treasury?
Yeah, I mean, look, Warsh, who was nominated to be the next Fed chair, I mean, he always had a reputation of being a hawk. So it was funny actually when they announced his nomination, the market kind of pulled back for a moment and said, "Oh my God,
Right, right.
he may not lower rates." But look, there are it's a very close circle of people here that are involved in Wall Street and that are economists. There are people like Stan Druckenmiller that are very close to Warsh, and these are people who understand markets. And I think Warsh has been pretty clear that we've left rates way too high. It's not a question is does the economy need to roll over, or do we need to see unemployment get worse? Or, I mean, it's actually fantastic. Our unemployment rate is really low, but the recent employment number wasn't good, and we can talk about AI and productivity and all that. That's having an impact, but it's pretty clear to the market, at least, that we're going to get, as you said, probably two cuts. I mean, look, there's going to be a little bit of an inflation blowback from the oil price. I mean, I don't know if you've got your recent fill up at the gas station, and regular gas, we were at like 280. That's probably gone to 350 now. So, I'm going to Costco on the weekend. I'm curious to see what my gas guzzler is going to take. But look, gas prices come out, and that's going to lift PCE and things like that. We're going to get PCE tomorrow, I think, and we got some CPI data that was pretty tame, but it's going to jump. It's going to push it up a little bit for sure. And so there will be some market concern. Is this inflationary near-term or short-term inflationary kind of shock going to keep wars from lowering rates? I don't agree with that. And I think, we should be quite confident that the yield curve, by the time Warsh takes office, which is in June, he'll keep the yield curve steep. And, when the yield curve flattens or inverts, that's usually a sign of a recession coming. When a yield curve is steep and going up, that's a good sign for the economy. That's when banks can earn net interest margins and things like that. So we're confident that, at least from a monetary point of view, we're going to get some easing. It's also quantitative easing. I mean, that's something people forget. And this is really the floor under treasuries as well. December 1st, quantitative tightening ended. And that's where the Fed was basically not reinvesting the treasuries that were running off. But now, the Fed or the Treasury is basically buying treasuries at 20 billion roughly a month. And that's just to keep the balance sheet steady. And that also puts a floor under the bond market. So productivity, should we talk about productivity growth or?
Yeah, we've seen the ISM numbers come through. I think the data is strong. Inflation's tamed. I know that I read a report recently, and there's so much noise. There's such a diversion of facts from one side of the spectrum to the other. But you hear something like stagflation, which for our listeners is high inflation and low productivity. Okay, what we've seen is quite the opposite. We've seen productivity, which I'll ask you about, really elevated and strong as it relates to ISM numbers that we've recently received. And we've seen inflation numbers come down gradually, if not aggressively, and anticipated to continue. That to me seems like a opposite of stagflation. What says you?
Yeah, no, absolutely. And the key thing is we do think inflation is on a secular downtrend, even though we have this sort of short-term blip here. And that's really key. And it goes back to what we see every day in AI. I mean, look, we use in our practice here, we use AI every day in terms of, even our analytical process. We've had an investment process that we've used for our Bulldog funds for over 30 years. And we used to have a stable of analysts, 10 to 20 analysts at CJ Lawrence. Now, the one analyst can do the same of 10 that 10 used to do. And that's really also the employment picture. We're losing a lot of entry-level jobs and things like that because of AI. It's productivity. But, in the near term, that's, of course, not good especially if you're a young person coming out of college or university. It's difficult to find an entry-level job. But there is a transition here. And I think the productivity gains are massive, and there are new jobs forming. It was, the big mistake was in the 1990s, when we had the internet build out, everybody was saying jobs are going to go away. And it's like, really the opposite happened. You had a whole new generation of people and jobs forming because of the internet. And I think the same will happen with AI. People don't know. It's, people like me or us, with gray hair, and we're trying to ask our young assistants and even interns to help us in our work. And that's just going to evolve, and that's the reason why we're getting weaker unemployment. It's not because we're in a cyclical downturn. I think that would be a mistake to, and that's why stagflation. Yeah, I mean, people are using the word stagflation. Stagflation is not a good scenario when if inflation rises and you have no growth, that's really bad for valuations. So valuations would come down. But if you look at the market, how the market is reacting to this, it's actually quite orderly. So where if you look at things like the S&P 500 and the Nasdaq, we're at the long-term moving averages here. We've basically taken some of the froth out, and we're back to the moving averages. That's not bad. We may test the moving averages. That's probably going to happen in the next couple of weeks, but in terms of the trend, it's not bad at all here.
Now, we all know that the second year of a first-term presidency, which is what this is touted as, is the least rewarding and the most volatile. Rationale behind that being it's a midterm election, policy changes. Let's talk about if you have an opinion on how this November goes and what historically we've learned from these types of consistent environments being it's the second year, if you don't mind.
Yeah, no, look, I mean, the election is, of course, looming out there, and all the talking heads are gaming that. From a market's point of view, we got a lot of the business-friendly policies in place, which was really important. So the big, beautiful bill that we got last year, it put tax cuts in place, it put accelerated depreciation in place. So one of the things that's happening this year is corporations that are doing CapEx have the ability to expense that CapEx in year one. So if you're some of the big hyperscalers that, some of them, there was this uncertainty about borrowing. A lot of them are actually getting, the ones that are building out infrastructure are actually getting big tax breaks or tax returns this year in cash. And that's because they were able to depreciate a lot of that investment. And on the consumer side, also, you're getting a lot of relief there. So I think there's a lot of liquidity that's driving that. I mean, deregulation, I think President Trump put in a lot of policies about everything from environmental projects to real estate to everything has made it easier for people to build things. And I think it's very difficult, even if the Democrats take the House, which seems to be what the polls are indicating right now. It's to reverse a lot of that. I doubt there will be a wholesale reversal of a lot of these types of policies because it will hurt the economy, and we'll see, by November where the economy is. And my sense is that, our base case for the economy is between 2.5% and 3%. On the low end, it's 2.5%. That's pretty good in the late stage of this cycle. We've gone through the high growth, the consumer-led part. Now we're more in the capex driven part of the cycle, which is more the late stage. So in that sense, 2.5% GDP growth at this point is actually very good.
Well, the deregulation that you talked about, the clarity on the big, beautiful bill, more importantly, the path that leads to activity and spending, and as you pointed out, liquidity, right? These are all positive things as it relates to economic expansion. And then you also have to consider the fact that we're dealing with an explosion of earnings. As you pointed out earlier, 5 consecutive quarters of double-digit earnings growth and 9 consecutive quarters of earnings growth in general. And then let's not forget what we're looking for next year, which is, ranging north of 13% earnings growth year over year. So continuing on that. And then you look at valuations, right? Your take on earnings, your feeling on how the market responds, the fact that tech is trading at a multiple that I have not seen with these types of earnings that we've had, as well as what's being projected at these low levels. What's your take on that?
No, absolutely. So look, when we had this conversation, I think a couple of years ago, we had noticed this 3 consecutive years of double-digit earnings growth going forward, and we were saying, wow, we've only seen that 4 times since the Second World War. So in the last 50 years, only 4 times. And then, we keep going. And that was, we've had all sorts of volatility in the last couple of years where I said, oh my God, people, we got to go back, reversion to the mean. The market is the valuations are elevated. And that's why the bull market has to end here. We were arguing, no, with this configuration of high growth, the market deserves a higher multiple. So for 5 consecutive double-digit earnings growth for the S&P 500, it doesn't deserve 16 or 17 times earnings, which is sort of the mean over the last 60 years. It deserves 20 or higher. And, that's where we are. So I think the earnings keep coming in. I mean, we had some very big earnings reports recently from NVIDIA, from Oracle, from some of the big tech names. The stocks didn't go up on NVIDIA's earnings and things like that, but the earnings were fabulous. So the companies are growing into the multiples. And if I told you what, if a couple of years forward for NVIDIA, it's actually a pretty inexpensive stock on 2-year or 3-year forward earnings. And we are of the belief that the AI build out we're still in early innings. We're in third or fourth inning in this. So you've got plenty to go on the semiconductor side. We still like tech and semiconductors, including things like NVIDIA. And the software, I mean, there's been a lot of hand-wringing about software either being put out of business by Anthropic and all the great agentic AI and all that. I think that's overdone as well now. So, there are some interesting ideas on the software side. So we like technology, but that's the part of the economy that's driving productivity and earnings. And we haven't seen earnings being even with the conflict now that we're seeing, we haven't seen earnings being revised down at all for next year or the year after.
The opposite.
Yeah.
2 consecutive quarters in a row, we've seen companies come out and adjust earnings higher.
Right.
And then deliver higher even beyond that. But your point on the conflict, it may be a little bit premature as it relates to any downward revisions. But you said something that I'm going to push back a little bit on. I respect your opinion, but you said something about CapEx expenditures leading to sort of the second half of this expansion in the secular bull market. But then simultaneously, you mentioned the tax bill, the big beautiful bill, motivating that. Is there any possibility, especially on the heels of what you just stated, in that a great deal left for the infrastructure and the implementation of AI? I think the policy could have actually promoted. Well, for example, I'll give you an example. These talking heads that I've been listening to for 30 years, and I feel like the old man yelling at the TV these days. But you hear them talk about, well, these companies came out and they spent more in capital expenditures in the fourth quarter than they told us earlier in the year. But they failed to mention that the law changed, motivating the 100% depreciation and the things that motivated that spending maybe forward to the current, or I should say previous tax year, so that they reduced their tax base and such. And I guess I'm going to push back and see what you have to say on whether you think there is some, are we in the 5th inning? Are we in the 7th inning? Are we in the 3rd inning?
No, look, I mean, CapEx, in terms of AI build out, we're in early innings. So that's with, 3rd or 4th for sure. The question marks about the build out of the infrastructure is what's the return on that in the end? And look, nobody knows, but all I can say to you is, or anybody, is really, look, we're using this technology every day. And you're seeing it across every sector that we invest in, and we're a pretty diversified fund. You're seeing the productivity gains in every sector, even the ones that are traditionally industrial sectors and manufacturing, machinery, all those things. I mean, it's amazing what this technology, where you can basically do scenarios in the virtual that you've never been able to do as an engineer or anything like that. So. Yes, maybe I wasn't too clear enough. I think we're early in this build out, and there are question marks about what the returns are, but we're going to keep building this out because the utility of the technology is massive, and it touches every sector. I mean, we talk about technology a lot and things like that, but healthcare, so pharmaceuticals. I mean, we're spending a lot of time these days in the pharmaceutical sector, because also what's nice about the pharmaceutical sector, it's driven by demographics, that, aging populations, things like that. So there are secular growth trends
let me just pause you there, because I'm going to come to sectors in a minute, and I want you to get more specific on which sectors you prefer versus lightened up on. But before I go there, I'm going to ask a question that I think is maybe misinterpreted by me, but certainly not talked about on the media outlets and really anywhere. A year or so ago, we had the BRIC nations: Brazil, Russia, Iran, China, and then of course South Africa, coming together, putting together their own trade on oil and importing it from, or getting it from, Iran and Venezuela, and purchasing it outside of the US dollar, which is of course the reserve currency. It was a popular topic. I brought it to your attention in the past. I have to say, you calm my nerves, because you said not in our lifetime is it changing. But now here we sit with that flip back. Now that Brazil, Russia, Iran, China, and South Africa can no longer purchase this whatever percentage of oil that we use throughout the world in this outside currency, and now it's back to the U.S. currency. Not to mention, Venezuela is being controlled, at least to a degree, the United States, and now of course Iran, which is who knows where that's going to end yet. But how does that play? You saw the dollar rise for the first time on a consistent basis for a couple weeks. I haven't seen that in a year or two. What's your take on that?
Yeah, no, look, I mean, you touched on something very important, which is the petrodollar. So, the petrodollar has been king dollar for all of our lifetimes and our parents' lifetime. So, yeah, what was starting to happen, which was, the Venezuela was starting to sell oil in other currencies, and other nations were doing the same thing, which was not only undercutting world oil prices. So basically, sanctioned oil was being sold at like a 20% discount, and in a different currency. So the Maduro, the Venezuela operation put an end to that, and basically put king dollar back on the map. So in terms of diversification out of the dollar when it comes to commodities, that was always wishful thinking in a sense. If you think about exploration of commodities, whether it's oil, gas, any kind of mining, it's actually always done in dollars, because the most liquid market in the world is still the dollar, and all commodities are traded in dollar. But you're right, it was creating a parallel market. But I think that's been pretty much shut down since Venezuela, and with Iran. I mean, Iran was trading oil in US dollars as well. As you said correctly, Russia was also exporting natural gas, mostly in other currencies. So I think a lot of that is being put to an end because of the military operations.
And as far as that,
it's lifted the dollar.
It's lifted the dollar, and how does that benefit? How does that hurt? What are some of the potential repercussions if it does sustain itself, which it appears it will?
Yeah, I mean, look, a stronger dollar helps capital flows. I mean, there was some worry that with some of the tariffs and some of the more the stronger kind of trade negotiations going on, that people would start trading elsewhere and things like that. So stronger dollar, if your investments in dollar are going up, that's good for investments into the United States. So, and capital flows into the United States. If you're an exporter, I mean, look, we've been reshoring a lot to the United States. Of course, if you're an exporter, that's not so good. But for the oil industry, which is the biggest exporter in the U.S. By far, rising dollar is actually very good.
Appreciate that. So sector-wise, what sectors are you most opportunistic and compelled in the coming, call it, year to 2 years? What sectors are you maybe even less compelled for different reasons?
Yeah, so where we are in the economic cycle, we still like technology. So technology is a sector weight and somewhat overweight. The overweight is more on the communication side. So that's the Metas and the Googles and things like that. If you think about what those hyperscalers are doing, these are businesses that are so profitable. They are large. I mean, Alphabet is a huge company, but I mean, they're growing revenues like 18% year on year, which is extraordinary, and their earnings per share is higher than that in terms of growth. Meta, companies like that are using, data and things like that for everything from advertising and all that. I mean, these businesses are phenomenal, and scale matters, and that's what's fun for us as large cap managers. In the 1990s, when we had the internet, it was all about small companies that's where all the action was. There weren't a lot of big companies to invest in that had all that growth. Today, it's all about having scale. So, technology we love. We're spending a lot of time, as I started talking about healthcare, so on the pharma side. And that is also a bit of reasoning behind that is what AI is unleashing in R&D is extraordinary. So we're seeing new things happening in the pipelines of some of these big companies. These are, I mean, Eli Lilly, about. This is GLP-1. I mean, GLP-1 is the weight loss drug. But it's not just weight loss. I mean, what the technology behind GLP-1 is unleashing is everything from cardiovascular, preventing strokes. There's a whole bunch of things that are behind that are going to come out in the next couple of decades. It's the same in immunology. I mean, with CAR T cell, the CAR T cell was a thing that was trying to prevent cancers and actually beat cancers. They're making a lot of progress in that field, and we're seeing things like that come to the market now, and that's because AI has really accelerated this process. So we're overweight healthcare, and it's big pharma. I mean, you've had some of the political policy squabbles with pharmaceutical companies and pricing and all that. We think that's kind of behind us. Most of the big pharmas have done a deal with the various governments on pricing, so we don't worry about that very much. And now it's all about the pipelines, and they look pretty good. So look, financials, we've gone underweight financials. I mean, there's a couple of things bubbling up, and that's typically when you have a lot of volatility, and yet when you're at the end of the economic cycle. I mean, economies go in cycles. You have expansion, then you peak, and then you have a brief down period, and then you kind of go into the next cycle. We're at the tail end of the current economic cycle, which can be long, but in that part you want to be a little bit less in the financials. We're seeing things like private credit. You'll see this on TV a lot now, where a lot of the private credit funds are being shut, or there's worries about liquidation. So one of the advice I always like to give in these cycles, you want to be in things that are highly liquid. We see this every cycle that companies shut the gates to alts, private credit, private equity, and things like that. Leave that to the institutional investor that doesn't need the cash when they need it. If you're a private client, stay away from those things. So you're seeing things like that bubbling up. So we've sold things like in the Blackstones and the Black Rocks that have gone heavily into private credit. We don't own those anymore. We like the banks and the JP Morgans and things like that, and the very large banks. They're all still fine, but you want to be careful with that. So we're underweight financial. So that's really the four main sectors. Industrials, we have a good exposure into industrials. These are the ones where there's digital transformation happening. Reshoring is a big theme there. The Rockwell Automations, the Parker Hannifins, things like that. They're all making a new high here. So defense, on the international side is actually on the there's a lot of great defense contracts from BAE Systems, which is the largest defense contractor in the UK, making a new high here. We own that in our international portfolio. Then there's German ones like Rheinmetall, which is one of the biggest munitions, and they do drones, they do tanks, they do everything. Even in France, there's some great defense contracts. I mean, actually, for the French, the defense sector is one of their biggest industries, and things like Thales are interesting names there. So look, there's always something to invest in. We're not. There's an abundance of things that we find attractive, so it's not like we're scratching our head to say what can we invest in. So we think
I think that you were very clear. The sectors you like, tech you led with. I don't know if it's your most popular, but based on valuations, I wouldn't argue that. Communications, the Googles, the Metas, certainly in a great spot here for many reasons. Healthcare seems to be where you had the most emphasis, which I believe is lagged because of the uncertainty of RFK, and lagged because it's the lagging benefactor to what's happening. And the market is a leading indicator, so maybe it's time. You don't like financials as much, which I hear is I'm hearing different opinions there. I tend to agree with you. Industrials as well is something that we've seen a nice movement in, and growth in earnings now 2 consecutive years, and seems like you're still seeing that as an opportunity. Defense obviously is a hot button today. One thing that you and I talked offline about that I'd love for you to share with my audience is international. International, for the first time last year, has had its opportunity to outperform the domestic markets, and then that goes back to 17. And then of course their impact, and in fact their I guess repercussions of this oil is far greater than it is domestically, because of course it's based in that, call it, part of the world. What I know you have an international portfolio, to be transparent, but what is your take as it is? What exposure potential to international? Why today, or why not today?
Yeah, no, look, the international stocks, and mostly European, got bid up early last year. So you had this massive, and the European stocks were up 30 to 40% last year in dollar terms. So a lot of that was the dollar going down. So the dollar lost about 11 or 12% versus the euro last year, and then the earnings and the underlying stocks was the rest of it. So a lot of people started then paying attention to, oh, well, as a diversifier, and again, I emphasize this as a diversifier, it makes sense in this pullback that we saw in international stocks to add some. We're talking 5 to 10% here. And again, these are companies that are world-class companies like BAE Systems, like Barclays Bank, that are out there that have really attractive valuations. And the energy shock has taken down these international, because the US is the most energy abundant country in the world. So we're blessed with all this oil and gas. So the rest of the stocks and the rest of the world have gotten hit more than us in this kind of downturn here. So if you're tactical, I think it makes sense to add a little bit of international here because the valuations look good. The fundamentals, I would still argue, the fundamentals in the US are second to none. I mean, the earnings growth and all that is still much better, but the valuations in Europe are not pricing in a lot of that kind of return to growth that we've been waiting for in Europe, especially in Asia, Japan. They have a new government there now and a new leader. So there are all kinds of interesting things happening around the world. And again, it's having a little bit of exposure there. That would be my sort of throwaway comment at the end. If you haven't allocated a little bit into international, this is a good opportunity to do that.
Good timing due to the pullback, due to the cost of energy being impactful, more so there than here. Awesome, phenomenal. Listen, I'm going to ask you one last question, if you will. Really hard to answer, I'm betting, but you always have the right answers when it comes to those hard questions, and then I'm going to tie it together. What do you anticipate the remain? Let's just assume, for argument's sake, that this situation doesn't explode greater than maybe another couple weeks.
Yeah.
Which of course impacts the GDP, like you talked about, like a specific 2.2% every $10 increase, and for how long it goes as well, it plays into that. What's your anticipation for this market at the end of the year? Because post-election, I think, is critical. And what is your, third year of a first-term presidency is the most rewarding. Did anything change? And this, it's different this time. I love that term. What is your take this year, next year? What do you anticipate for this market based on all the strengths that you pointed out, as well as the headwinds?
Yeah, look, I mean, with the fundamentals, so bottom-up earnings growth and rates coming down, we were modeling 10 to 15% for the S&P for this year. Okay, that's before the conflict. So yeah, there's a lot of things that we just don't know, and I'd be I don't want to, I'm not a military strategist. I'm not, that's not what I do. But my gut feeling is this is going to be resolved one way or the other, and we can get back to the fundamentals. So we hang our hat on the massive earnings growth that we're seeing. So, we're looking at, almost 15% earnings growth for this year. Okay, what if that's 10? So then I would be very disappointed if we don't get 5 to 10% out of our stocks, even with a little bit of multiple compression because of geopolitical. So, I think at the low end, 6 or 7%. At the high end, you could get double digit for the S&P. That would be something we're modeling. I mean, yeah, there will be hand wringing going into the election in November for sure. That always creates volatility. But I think once we know where the chips fall, I think the market will start, pricing in the fundamentals more. And my sense is the fundamentals will continue to be strong, and that's because of AI, productivity growth. I mean, productivity is adding about 0.7% to GDP every year. So, and that's because we can do a lot more with a lot less, which is extraordinary. And again, we are the leading country in the world when it comes to this technology. AI, we are so far ahead in AI. That's something, we can really hang our hat on also as investors. So
good. You're so good, Bernhard. I appreciate you big time. Listen, a seasoned gentleman who's one of the most touted growth managers, not to mention his strategy, the Bulldog, not to mention his international experiences and exposure, leveraging your brain to get us a different voice, if you will, taking us away from a lot of the noise that we're hearing in the news, also referred to as noise. I think the takeaways are as follows. If you have designed your portfolio and your allocation to the tune of longevity, in other words, you've created enough liquidity to get you through the known and the unknown, and then you've also identified the longer term money and as well the discretionary income that you can continue to layer into the longer term strategies attached to those dollars. This is our friend. What is this? Volatility, right? Volatility is always here. I want to remind our audience that a 10% correction once a year is pretty much definitive. It's been every year. I can give you every example. A 20% pullback is typical of every other year. Happened last year in April. Hopefully we don't have to experience it anytime soon, but it'll be here again. A 3 to 5% correction every quarter. One might ask, well, why in the heck would I invest with those type of data points? And the answer is because the market averages over 10% a year going back well before you and I were ever here, Bernhard. And that brings us to the point of dollar cost averaging, a well used and probably overused term, which means continuing to layer into the long-term portfolio that you've predetermined that you monitor and taking advantage of these types of scenarios. And what I also heard a seasoned comment by the seasoned vet, Bernhard Koepp, is that the fundamentals will eventually win. The data, the earnings, the valuations, which all align to very positive deregulation, strong, explosive earnings, more than I've ever seen in my career, a Fed that's accommodating, a dollar that's getting stronger, all of these things that we're dealing with that just so happen to always be in election years, that creates volatility will eventually pass. And let me remind everyone that the third year of a first-term presidency is historically the most rewarding. So if you're in it for the longer term, which you had better be if you're investing in equities, this is an opportunity. It's partners like you, Bernhard, that give us the details that behind the scenes we need to stay calm, stay focused, and understand the objectives and deliver them without emotion and be methodical in the process. And I thank you. I thank my audience for always joining us, and know that we'll be here with all hands on deck at FWM, Fratarcangeli Wealth Management, ranked in the top 50 in the investment advisory world by Forbes and others for over 7 years, and the number one for the states we're in for those 7 years as well. And we fight to continue to take care of our clients and have the attributes and the access like you, Bernhard, to continue to deliver these types of guiding points. And thank you all. I'll see you soon.